Warren Buffett bought China's BYD Auto. So, should you buy it now? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about BYD is that Warren Buffett owns 20% of its outstanding H shares. This is Andrew Stotz of the Valuation Masterclass case study. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or recommendation. So, is BYD the policy winner of China's 14th five-year plan? This is a Berkshire-backed automobile and electronics giant with a market share of 28% in China's new energy vehicle market. There's three things to know about the company. EV rollout is on track with massive government support. Smartphone segment continues to be a reliable revenue driver and climbing up that value chain to stop margin erosion. Let's review some key statistics. There's 39 analysts covering the company, and consensus has it share price at 365 Hong Kong dollars. It's listed in the Hong Kong Stock Exchange. That's a 27% upside. A PE is a little bit high at 179, and the dividend yield is 1.1%. Our estimate, 342, that's a 17% upside, meaning it would be a buy. Now, massive outperformance compared to the index. Despite the government's lockdown to combat the pandemic and supply chains disruptions from the Russian war, BYD managed to keep its goals on track. In fact, this is mainly attributable to strong government support, subsidies for producers, purchase tax exemption for buyers, and support for construction of charging infrastructure. Pretty impressive that the company was able to keep its share price up that high. Now, why is EV so important for China? China is heavily dependent on oil imports. In fact, oil consumption in 2021 stood at 15 million barrels per day, compared to only 4 million of production. Mass adoption of electric vehicles could help to reduce oil import for the long run. China wants to lead the technology race and dominate the EV industry, which I think it really can. Now, we were talking about Warren Buffett. Let's look at Warren Buffett's investment. Warren Buffett first invested in BYD back in 2008, purchasing 225 million shares worth $230 million US dollar. His stake is now worth $7.7 billion US dollars. He does it again. The guy's got a magic touch. This is equivalent to a return of approximately 3,200%. Now, it was his friend Charlie Munger who convinced Buffett of this. Munger has long been known to have a bullish outlook on China, and he's believed that BYD is well positioned to lead China's EV transformation. Munger had previously praised the founder of BYD, Wang Chuanfu, for being a combination of Thomas Edison and Jack Welch. Let's look at the sales or the revenue breakdown. First, we can see that 70% of the revenue is coming from China and 30% international. 50% of the revenue is coming from automobiles. Now, that's kind of interesting. This is an automobile company, and yet only 50% is coming from automobiles. So what's the rest? Well, 41% is coming from mobile phone handset components. Interesting. And then we have rechargeable batteries and photovoltaic with another 7%. So we've got some interesting story there. Let's go into it. The EV rollout is on track with massive government support. Now, China trails behind large developed markets in terms of EV penetration. This chart shows the number of EVs per 1,000 residents, and it's only 3 in 2020 in China compared to 8.5 in Germany and 5.2 in the US. So lately, the Chinese government considered extending its purchase tax exemption for EV buyers. The supportive policy is expected to lead to a convergence with the West of the EV penetration rate. Now, the underpinnings of demand for EV in China come from the Chinese government's ambitious targets, which lays the strong foundation for revenue growth. In 2021, EVs accounted for 13% of new cars sold in China. By 2030, China plans to ramp this number up to 40%. This means that the regulatory environment is helping BYD to realize its growth potential. Now, this is interesting to think about Buffett. Here we have Buffett investing in what you could say is ESG type of company that's bringing electric vehicles. And then on the other hand, he's buying Chevron and some other oil companies, which I would say is an anti-ESG play. And then he's bought, BSNF, or BNSF, the railway, which you could say is also an ESG play because of its low consumption for distribution of products of energy. Now, the smartphone segment continues to be a reliable revenue driver. Now, this is where I think it gets interesting. Nowadays, BYD is more known for its vehicles. However, its mobile phone handset assembly segment doesn't trail far behind. Major clients of BYD include Huawei, Apple, Samsung, Xiaomi, and Vivo. As of first half 2022, these brands collectively made up 80% of the global smartphone market. Now, emerging markets could constitute a new engine of growth. Smartphone penetration, we can see here, emerging markets like China and India have lower smartphone penetration rates than saturated developed markets. This means there is still some room to grow. By partnering with dominant smartphone players in India and China, this segment could continue to deliver double-digit growth. Now, climbing up the value chain to stop margin erosion is the next story number 3. BYD has surpassed Tesla in the number of new EV vehicles sold in first half of 2022. Boom, it beat Tesla. However, its margins trails Tesla, so profitability is less. BYD intends to turn around the negative trend by introducing more premium models that can be sold at a higher average selling price. What we can see is the gross profit margin has come down from about 17 down to close to 10%. That is extremely low, and they need to make progress on that. And if they can, it will be amazing. Now, example of BYD's premium models include BYD Han, BYD Tang, and BYD Quin. And let's look at the forecast. Here we can see the consensus is pretty bullish. There's 27 analysts, and the upside is 27%. Most analysts have buy or strong buy recommendations, but analysts predict the company is going to maintain double-digit revenue growth, and this is in line with our forecast due to support for new energy vehicles coming from the Chinese government. So we're talking about massive growth, 68% this year, 29% next year, and 21% in the coming year, 2024. Now, the massive EV rollout in China and capturing upside in the smartphone business is what's driving strong revenue growth. BYD has high level of working capital requirements, accounting for close to 50% of its total assets. That's a heavy load of accounts receivable and inventories. And the last thing you want to see is a car company stuck with inventory. So BYD's cash generation ability has been improving since 2020, making its financing less reliant on external debt. That's good. It's mainly equity financed. In the past, BYD improved its efficiency, and I expect that trend to improve. BYD is not highly levered, and the company became a net cash company in 2021, which is pretty impressive. Now, if you want to learn how to value companies like this, join my 6-week valuation masterclass boot camp. You'll learn practical valuation skills, access my tools, tips, and tricks, join a group of inspiring financial professionals, and get a job through my network of financial industry leaders. Check when you have time to join. The next boot camps are scheduled for October 10th and January 9th of 2023. If you're watching this video, you get an additional 100% off. Just scan this code or go to valuationmasterclass.com/bootcamp and remember to use the coupon code YT22. Let's look at valuation. We're going to go through the Stotz Investment Research Stock Picking Checklist. It's inspired by Peter Lynch's book, One Up on Wall Street, where he talks about 10-baggers, stocks that go up by 10 times. We did extensive research on 10-baggers and found 9 factors that drive long-term share price performance. Number 1, management is committed to growth. That's a good one. Over the past 9 years, revenue grew at a CAGR of 20%. Number 2, growth can hit double digits. That's good also. Government support along with underpenetration of EVs should provide plenty of growth. Gross margin can remain high. That's also good. Margin is below peer group, but company is increasing it. Now, you could say that this is moderate to good because the margin is low now, but there's a lot of room to increase. If we can see revenue rising and margin expansion, man, that could really drive the share price. Earnings are predictable. Well, this is weak. There's a high level of exceptional items. How about the efficient at deploying assets? This is moderate. Asset turnover has been on an increasing trend, but still below 100%. Cash conversion cycle is low. Well, this is moderate. Cash conversion cycle is decreasing, but still remains high. Cash flow is consistently positive. This is good. Operating cash flow is higher than its investing cash flow. And capital is readily available. The company is net cash. Finally, valuation is reasonable. This is a little bit weak because the company trades on both PE and price to book. That's relatively high. So what do we think? Is it a 10-bagger? Ladies and gentlemen, no, it's not. I think the potential is a 5-bagger in this particular case with strong revenue growth and a rising gross margin. Now, if they can't turn around the gross margin, it's not going to happen. Let's look at the free cash flow. Increasing CapEx is necessary to lay that foundation for massive growth. So let's look at our value estimate. My forecast is similar to consensus as I expect gross margin to expand. In the long run, I expect competition to rise. Therefore, I choose a terminal growth rate of 3%. I'm using the free cash flow of the firm valuation method and a cost of equity of 8.7. And because it's net cash, basically the weighted average cost of capital is about the same. What conclusion do I get? My base case is 342 Hong Kong dollars. That's an upside of 17%. My bull case is 377 Hong Kong dollars, and that's an upside of 28%. And my bear case is 307, which is an upside of only 5%. So what are the risks? Well, let's look at it. Increasing number of players in the domestic market puts growth at risk. Sudden changes in government regulation that could be less favorable, and failure to keep up with technological changes. Now, also, you could argue that if you were an American investor like Warren Buffett investing in a Chinese company, you have to worry about, are there some sorts of retaliations that the U.S. government is going to do that's going to cause you to have a problem getting your money out or having some other tit for tat going on between the U.S. and China. So what are the conclusions? China's ambition to lead the EV race unlocks massive growth potential. Strong smartphone segment delivers secured revenue for BYD, and margin expansion could constitute a catalyst for the share price to rise. So my question to you is that Warren Buffett bought China's BYD Auto. So should you buy it now? Let me know what you think in the comments.